Hello, very good morning to all, and welcome back again to today's Daily Dose of Market Insights. I'm Kelvin here. Very good morning. Today will be Thursday, the 5th of September 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term intraday technical outlook, as usual, we will have a recap of what has taken shape yesterday in terms of economic data, respective news flow releases, and their impact on the major cross-asset classes, and as well as followed by a more of a medium-term fundamental and intermarket dynamics that is particularly interesting for a respective cross-asset classes that I will share with you all for today. And lastly, as usual, will be the things to look out for in terms of news flow or economic data for the rest of today. All right, so before we start over here, let me do a sound check first, so that I hope that you guys could actually hear me loud and clear. Just give me a few seconds to do a check. All right, I think it's all good. Yeah, so now let us now take a quick look at what are the key economic data that was released yesterday. So one particular, not really key data in terms of US perspective, will be the release of this jobs data over here, JOLDS, jobs opening. So this is more like a second tier labor market data that kind of indicate the state of affair for the US job market or labor market. But for sure, the tier 1 job data will be centered on this Friday NFP data that consists about the absolute number of jobs opening per month basis, as well as the latest unemployment rate that kind of tick up in the last 2 months. So in this jobs JOLTS jobs job opening, it tends to be rather lackluster because it actually continues to actually decline, slightly lower from 7.91 million jobs added in the month of June over here. And what we could see over here is that it was also being revised downwards from 8.18 million that was previously recorded from the month of June. So it was revised downward. So yesterday's data release indicate a print of a 7.673 million, which is also lower than 8.10 million of jobs added. So if you look at the trend in the last 6 or 7 months over here, it's slowly showing signs of deceleration. All right, so based on this second tier what do you call it, labor market data, we do actually express a kind of concern about the state of the labor market. And if this Friday the top tier 1 NFP data and as well as the unemployment rate continues to show lackluster job situation or labor market in US, that could actually increase the odds of a hard landing in the US economy. And if that particular scenario happen, we could start to see a much more we call it a significant underperformance on the higher beta major US stock indices, which is the Nasdaq 100 and the S&P 500. And initially, last week we do share with you all that potentially there could be this ongoing outperformance of the Dow Jones Industrial Average and the Russell 2000. But there is a big caveat to that, is that the US economy cannot slip into a recession in order for the Dow Jones and the Russell 2000 to take the front seat. All right, so now this is the data that has taken shape yesterday, and its impact on the major US stock indices was rather muted. not so much of a significant movement, as you could see over here. So the major US stock indices kind of close in a rather mixed fashion, not that dramatically down, with the Dow Jones Industrial Average outperforming the rest, almost unchanged with a slight minor gain of 0.09%, whilst the SPX and Nasdaq 100 continues to actually kind of shed minor losses of negative 0.16% and negative 0.2%, and the Russell 2000 is down almost on the same magnitude as the Nasdaq 100 at negative 0.19%. And the culprit that causes the underperformance of the Nasdaq 100 and the SPX is the heavy weighted NVIDIA, because NVIDIA is the third biggest weightage market cap inside the S&P 500 and as well as the Nasdaq 100, and it starts to spread into other mega cap stock as well. So NVIDIA has continues to plunge yesterday, negative 1.7%. It continued its loss, extended its loss, and it caused a negative feedback loop into the other two mega cap technology stocks, which is Apple down negative 0.9% and Google down negative 0.5%. And what we could see in the heat map over here is that we do see pockets of green, especially in the defensive sector. Consumer defensive will be consumer staples and as well as the utilities, which show in the pocket at green. But the consumer defensive or consumer staples and utilities and some high of some signs of pocket of green in the industrial and the healthcare are not able to actually manage the S&P to close in the positive territory, because this particular outperform sectors has a very small weightage compared to the information technology sector and the communication service sector based on the market cap basis. So if you look at the groups over here very clearly, this is what I shared, what I mean earlier on just a few seconds ago. Okay, this is the one-day performance of the 11th sector within the S&P 500. So very clearly, the defensive utilities, consumer defensive, some form of real estate will be considered. A significant portion of them will be in REITs as well, US listed REITs, followed by industrials. All of them, these top three are actually outperforming the major SPX 500 index. And the one that is the bottom will be the technology, communication services, basic materials. Energy was the worst due to the fact of this softness in the two US oil, WTI crude oil price, okay, due to the negative feedback loop after the major breakdown of its range support level at the 73, 72 US dollar per barrel 2 days ago. Okay, so this is the performance of the major US stock market. And in the FX market over here, interestingly, right, yesterday I did share with you all there's this so-called, let me share, bearish reversal candlestick that has been formed on the US dollar index over here. Okay, let me expand my screen. Okay, oops, I think it's hanging right now. Okay, good, it's open already. So what we could see over here is that the medium-term downtrend, because this is the daily chart of the dollar index, has started to resume after that 4 day of rebound that has taken shape on last Wednesday. And we start to see these two bearish reversal candlestick, spinning top, then followed by a kind of a black marabuzu yesterday. So it tends to actually indicate that there is continuation of this impulsive down move that is taking shape on the FX market that are more skewing towards the dollar weakness at this juncture. And if you were to look at this instant, because don't forget the dollar index is heavily weighted in the euro dollar. Yeah, because the dollar index does not has Kiwi and Aussie dollar inside this US dollar index. But nevertheless, if you were to look at the 5-day rolling performance of the dollar against the major currency, which I plotted Aussie and Kiwi as well, we start to see it coming down. All right, and the worst hit was the dollar yen, because dollar yen yesterday, we do attempt to look for at least one more push of minor bounce, and the minor bounce didn't surface, and it broke down below our key short-term pivotal support at around the 144.35 level mark, and after that it triggered that dollar weakness against the yen in the US throughout the US session. So they actually explained to us why the dollar was the weakest against the Japanese yen, because it triggered a downside breakdown of a key short-term pivotal support that we highlighted yesterday. So this is kind of technically driven instead. And the rest of the other major currency against the dollar continues to show gentle dollar weakness. And the one that is kind of lagging behind will be the Aussie and the Kiwi, still kind of traded sideways at this juncture. Right, so this is the short-term intraday performance that we have taken shape so far in the FX market. Some signs of dollar weakness coming back into majority of the major pair. Okay, with acceptance of the Aussie and the Kiwi that is still kind of being trapped in a kind of a minor sideways range at this juncture. And most importantly, gold price. So gold price managed to hold on to the 20-day moving average that we highlighted yesterday, that 2,473 key short-term pivotal support. Yesterday, it managed to actually retest that psychological 2,500 level. So it seems to us that gold price are still being supported at this juncture. Right, so later I'll share you more about the intermarket on gold, as well as the short-term intraday technical outlook on gold as well as we proceed to that session. Okay, so with that over here, now let me share with you all one particular intermarket dynamics that is taking shape in the US market right now. Will be this particular market breadth of the S&P 500 and the Dow Jones Industrial Average. Sorry, pardon me. Excuse me, sorry about that. Actually, the market breadth on the Nasdaq 100 and the S&P 500. All right, pardon me, of my cough earlier on. Okay, to actually rejig my speech for a while. So if you look at the Nasdaq 100 stocks, means component stocks, percentage of component stocks above the 20-day moving average, it actually starts to inch downwards from a high of 85% all the way down to 51%. All right. And what we could see is that the percentage of stocks holding above the 50-day moving average, that means percentage of Nasdaq 100 component stocks above their 50-day moving average, also starts to inch downwards, and it's now below 50% at 48.51%. So we start to see over here is that the market breadth on the Nasdaq 100 stock is getting weaker because of the reduction in the percentage of stocks that are holding above the 20-day moving average, and more significantly above the 50-day moving average at it breached below the 50% level mark. So what we could see over here is that the weakness which I shared with you all yesterday, this elevator, we call it, put away that the elevator effect of NVIDIA towards Nasdaq 100, because and in some form on the S&P 500, because this particular NVIDIA is a kind of a very heavy weighted market cap stocks, and in terms of sentiment, it also driving the AI optimism sentiment since the start of last year. And this year, NVIDIA is the top performing stock that surpassed all major US stock indices, the benchmark stock indices, by closing close to about a 200% gain. So given that it has a significant weightage in terms of sentiment, any form of weakness on NVIDIA could actually spread a significant negative feedback loop into the Nasdaq 100. And do not forget, the Nasdaq 100 also consists heavily on the mega cap stocks, and some form of them like Meta, Amazon, Apple are actually partnership with, in a way, indirectly with NVIDIA, because they also trying to introduce AI related product services into their suite of range of services to their customer. So take this in the form that market leader. So once a market leader or market general get weak, the foot soldiers will also start to actually fall down in line as well. So they're actually being expressed in the component stock in the Nasdaq 100, and it slowly starts to actually spread down to the other index that has a significant influence in the Nasdaq 100 as well, on the S&P 500, right? The S&P 500 fall at a slower pace because it still has some weightage in the financial stocks and as well as industrial stocks, all right, and basic material stocks. So what you could see over here is that it fell down, but it didn't actually go down to the 50 level mark in the percentage of stocks within the S&P 500 that is holding above their 20-day moving average is still at 71%, all right, after a slide from 89% about a week ago. And the percentage of S&P stocks holding above the 50-day MA is still holding above the 50% mark at 69.6% over here. right? But the issue over here is that if the Nasdaq 100 market breadth continues to get weaker and they move in line with the S&P, it has an influence on the S&P 500 as well. There's a big risk that the S&P 500 market breadth will follow suit with the Nasdaq 100. All right, so something to actually take note of from a intermarket perspective. All right, so this is one of the chart I want to share with you, and the other intermarket perspective is more on the gold price. For this, I tend to actually share with you guys. I believe that some of you may have already seen it, but nevertheless, let me share again. All right, it should be this particular chart over here. Okay, let it load for a while. Okay, not this one. Okay, I think it should be this, the other one. Okay, give me to load that chart, that the intermarket chart on gold. Yeah. Oops. Okay, I think this should be the one. Yeah, this is the chart on gold. Okay, so I want to share with you all this particular chart on gold is by looking at the opportunity cost of holding gold, real opportunity cost. That means by plotting the US 10-year Treasury real yield, not the nominal yield. That means, i.e., I take into account of the nominal yield minus of the 10-year interest, 10-year inflation expectation. Okay, as derived from the break-even rate. So what I could see over here is that yesterday's price on the daily basis managed to shape two bearish Marubozu candlestick and looking to breach below a key major support at 1.62%. So if the US 10-year Treasury real yield break below this 1.62%, and based from a technical perspective, there is high odds on it. Why? Because of the appearance of these two bearish Marubozu candlestick on Tuesday and as well as yesterday. So a breakdown below it potentially exposes the next major support at 1.382. That is what I call a potential double top breakdown on the US 10-year Treasury real yield. All right, the first top, the second top, and this is the neckline support, right? The major neckline support. A breakdown takes us out down to 1.38% in first step. So what it means that the opportunity cost in terms of real opportunity cost of holding gold in the long term may be greatly significantly reduced, okay, by the breakdown of the 10-year US Treasury yield. And in terms of competition of money flows or inflows with other asset classes, there will be less competition because the opportunity cost of holding gold will tends to be lesser, and that could also potentially support higher gold price going forward in the near future from a multi-week perspective. All right, over here. So if you look at the gold chart, the price of gold XAU/USD continues to actually trade above the 50-day moving average, and as well continues to trade above the upper limit of this major ascending channel. That means above this dotted line over here, above this dotted median line at the upper limit. Okay, so this is the second half, then this is the top half. It's going to trade at the top half of this major ascending channel that is in place since 5th of October low 2023. So i.e., what I'm going to try to stress for you guys is that if we start to see a major breakdown of the US 10-year Treasury real yield, we are time to think, it will start to lower the long-term opportunity cost of holding gold, and that could actually further potential benefit gold price XAU/USD. And in terms of its major uptrend phase, it remains intact, and also potentially it could start to see higher high and shape a fresh new all-time high above the 2532 level that was printed about 3 to 4 weeks ago. All right, for gold XAU/USD. So now that is the current intermarket dynamics down and share with you guys. So right now, with that in mind, now let me expand my screen before we jump straight into the key intraday technical outlook on the various cross asset classes over here, so that you guys could actually have a better visualization on the key technical levels. All right, so with that, let us start with the FX market first. over here. So if you recall, on the euro dollar, we flipped to a bullish bias yesterday because of the appearance of that bearish candlestick in the dollar index, and given the fact that the euro is the biggest weightage in the dollar index. So what I do over here is that yesterday we do have a pivotal support at 110 figure level, and given that yesterday price action has clearly taken out the 20-day moving average, overlaid on the hourly chart over here, we will tighten our key short-term pivotal support to Wednesday. I would say that Tuesday US session swing low at 1.1026, with a first support slightly higher at the 20-day moving average that is acting as a support right now. Okay, at this 1.1055 level or 56 level, okay, 1.1057 level over here. So as long as the price action didn't break below 110.26 for today on the euro dollar, we will maintain that intraday bullish bias. Next near-term resistance level to watch on the intraday basis will be 110.05 followed by 111.40. Only a breakdown with hourly close below 110.26 will invalidate today's bullish bias on the euro dollar to actually see the extension of this minor corrective decline to resume, to expose the next near-term support level at 110 figure followed by 1095, which correspond to the rising 50-day moving average as well. Okay, so that's for the euro dollar. And given the positive impact on the euro dollar, it has a positive feedback loop into the sterling dollar as well. So the sterling dollar continues to rise yesterday and almost hit our first resistance at 131.90 before shaping that pullback in the late US session. So the first support level to watch will be this minor congestion zone over here at 131.13, but no change, still use 130.80 because this level is a bit tight. So as long as 130.80 continues to hold in terms of its short-term pivotal support, we will still maintain that short-term intraday bullish bias on the sterling dollar. A breakout above the first resistance at 131.90 potentially exposes the minor swing high of last Wednesday at 132.65 next on the intraday basis. Only an hourly close below 130.80 negates this bullish bias to see the extension of the minor corrective decline to actually retest the 20-day moving average, acting as converging with the next support zone at 130.40/130.10 next. Okay, so that's for the sterling dollar. Now moving on, our focus to the Asia Pacific currency against the dollar will be the Aussie dollar. So the Aussie dollar yesterday, we do have a short-term pivotal resistance at 67.60/67.75. And given that it's kind of trading sideways right now over here, yesterday it hit almost hit the lower limit of the short-term pivotal resistance, then thereafter it traded sideways again. So but what we could see over here is that the RSI has started to see a series of higher low, right? A higher low over here. So given the fact that the series of higher low, and there could be a spillover, we call it feedback loop impact on the dollar weakness that's being seen in other major pair. Potentially we could see a minor push up towards inside, at least inside towards this first resistance zone for today, which was yesterday pivotal resistance at 67.60/67.75. So I will use the 67 figure level, which is very close to the rising 20-day moving average. So this will be my short-term pivotal support level. I will flip to a bullish bias, but only looking for it for a potential exposure towards this resistance zone at 67.60/67.75. Unless it could have a clear break above 67.75, then we could potentially kind of validate further signs of potential recovery to retest last Thursday swing high area at 68.20, unless 67.75 breaks. So i.e. there's only two levels to watch for today. Key pivotal support level will be 67 figure level because of the rising RSI that is being showing some signs of short-term momentum, but we're only looking for the first resistance level at 67.60/67.75, and that level also confluence with the golden ratio, taking into account of the recent push down over here, right, at 61.8% golden ratio retracement level, which is acting as a potential resistance level as well, confluencing at the 67.75 level mark. All right, but however, if price action don't push up and test the resistance, and instead it starts to plummet down below 67 figure level, then we will flip back to a bearish bias given that's a clear break below the 20-day moving average, to expose the next near-term support level at the 66.40 level mark, which is in between the 50-day and the 200-day moving average. Okay, 66.40 next. Okay, so that's for the Aussie dollar. And right now, very quickly, let us flip our attention now to the dollar yen. So dollar yen yesterday very clearly broke down below this minor trend line support level that I drew from the low of 5th August, which was yesterday's short-term pivotal support yesterday at 144.35. Initially, we are expecting at least a rebound back towards the 20-day moving average, but price action instead starts to actually plummet below it and retest the low of last Monday of 143.45 before shipping a minor bounce in today's Asia session. And given the fact that its hourly RSI has started to exit from the oversold level, potential this bounce may continue to extend to retest back above the 144.43 level, which is the pullback resistance of that former ascending trend line support level that has been taken down, maximum potentially at this 145.40/90. So if we will do a Fibo retracement of this ongoing slide from the 3rd of September all the way down to today's Asia session low, it actually correspond to the golden ratio at 61.8%. All right, over here, and the 20-day moving average slightly above it. So as long as this ongoing bounce didn't actually surpass 145.40/90, I give a bit of tolerance, which is the 20-day moving average as well, we will flip back to a intraday bearish bias on the dollar yen, a breakdown below 143.45. Thereafter, re-exposes a further downside move to retest the low of 5th of August swing low area at 141.60/40 next on the intraday basis. But however, if price action starts to do a break up instead, that means if the bounce starts to surpass above 145.90, then this bearish bias will be invalidated to see another round of very choppy corrective rebound phase taking shape again to retest 147.50 next. Then above it, sees the extension back towards the 149.30 level, which is the minor swing high area of the 15th of August, and this particular dotted line over here. So this dotted line is in fact a former dotted gray line, is in fact the former major ascending channel support that I drew from the low of January 2003 down turns into a pullback resistance, also very confluencing very closely with the 149.30 short-term pivotal 149.30 resistance level. All right, graphical resistance level, which is the minor swing high of 15th and 16th of August. Okay, so that's for the dollar yen right now. So with that sum up the intraday technical outlook for the major FX crosses. So now let me share with you one major FX pair, not crosses, FX pair. All right, pardon me. So let me share with you one Euro Aussie FX cross that seems to us that is showing some form of interesting technical configuration on the short-term basis. What is the hourly chart? So on the Euro Aussie over here is a FX crosses cross pair. That means I take out the dollar from it. So it managed to actually get rejected from the 20-day moving average after initially staging a rebound from 29th of August all the way up to yesterday, 4th of September. And what we could see over here is that the hourly RSI, okay, also has broken down below a former parallel trendline support as well and retest on it yesterday, all right, before shipping a bearish reaction on it. So with that, potentially what we could see over here is that given the bearish reaction of this 20-day moving average, the Euro Aussie together with its short-term potential bearish momentum reading that's been depicted on the hourly RSI, we call it a level right now, using 165.20 as my short-term pivotal resistance, which was yesterday's minor swing high, corresponding slightly below above the 20-day moving average. Potentially there could be some form of further weakness on the Euro Aussie to resume its minor downtrend that is in place since the high of 5th of August over here, to at least in short term revisit 163.70. A breakdown below it exposes 162.60/161.80 next. Okay, 162.60 will be the low of 29th of August, last Thursday low. 16180 is this congestion area over here, 2nd of June to 16th of July. Okay, only an hourly close above 16520 will invalidate this intraday bearish bias on the Euro Aussie to see the continuation of this rebound to expose the next near-term resistance at 16590, followed by 16710 on the intraday basis. All right, so that's one of the FX crosses that we could actually take note of for today. Okay, now let us now focus our attention to the major stock index or indices, starting with the Asia Pacific Index, will be the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index continues to remain lackluster. So over here, no change. What we could see is that the price action now is breaking below our first support level at 17,540 / 17,430. So with that, I will use a slightly tightened key short-term pivotal support level for today, put it down slightly lower, very close to today's intraday high, which is at 17,595 over here. Just put it slightly lower, 17,595. Okay, so using 17,595 as my short-term pivotal support level, still maintain that short-term intraday bearish bias on the Hong Kong 33, with the next support zone to watch will be at the 17,270 / 17,185 support zone, which also confluence with the 200-day moving average acting as a support. And if you will do the Fibo retracement of the prior push-up from 5th of August all the way up towards the high of 30th of August, it corresponds to the golden ratio as well. Only an hourly close above 17,595 now will invalidate today's intraday bearish bias to see a push up to retest 17,925 and even potentially 18,070, 18,160 next. So that's for the Hong Kong 33, i.e. the Hang Seng Index. So now the Japan 225 yesterday, we flipped to a bullish bias over here. And what we could see over here is that there is another signs of potential exhaustion of this bearish momentum that has taken shape since the high of 2nd of September all the way down to yesterday's US session intraday low of 36,190. So will be the appearance of this bullish divergence that's being seen on the hourly RSI. Okay, so with that, still no change, still using, okay, so what I do over here is that I will adjust slightly. That means there's a bit of excess right now. Let me push down lower to this level here. Okay. Okay, using this 36,360, a bit of excess over here. Okay, so a bit of excess, 36,360, taking into account of yesterday's US session push down, but with the appearance of this bullish divergence on the hourly chart over here, we will actually still maintain that short-term intraday bullish bias, but it got to actually surpass the first resistance zone, which we highlighted yesterday as well, at 37,560 / 37,860 to see a much more substantial recovery over here towards 38,470. All right, so in first step, the potential bullish bias first resistance level to watch will be at the 37,570 / 37,860 first, because there's also confluence with the 200-day and the 20-day moving average acting as a resistance level as well. Correct. But however, if price action starts to break down below 36,360, then we will start to see further weakness towards 35,860. A breakdown below it exposes 34,500 next. All right, so that's for the Japan 225, i.e. the Nikkei 225. Now shifting our focus towards the major one of the major European stock index will be the German 30 or the German DAX. So the German 30 and the German DAX managed to stage a bounce from the first support level that we highlight at 18,550. So still using the 18,350 as my short-term pivotal support level, still maintain that short-term intraday bullish bias for at least looking for some signs of a minor bounce in first step towards the first resistance to watch on the intraday basis at 18,820. Okay, 18,820. But however, if price action starts to break down below 18,350, which is so confluence with the 50-day and the 20-day moving average, then this particular minor corrective decline will continue to extend on the downside to expose the next near-term support level at 18,074. A breakdown below it sees the 200-day moving average coming in at 17,820 support level next. All right, so that's for the German 30. And with that, let us now take a look at the major US stock indices, pardon me, starting with the Dow Jones Industrial Average, which is the US Wall Street 30. So as usual, the US Wall Street 30 yesterday, we have a neutrality stance between 41,200 and 4610. And indeed, the price action managed to bounce, but can't surpass above 41,200 level, which is indeed a key short-term range resistance that we got to take note of on the US Wall Street 30. And given that it's still holding within this range neutrality zone, we don't want to be so aggressive to flip to a bullish bias, nor to a bearish bias on the US Wall Street 30. So still keeping a neutrality stance between 41,200 and 40,610 is just to look out for a breakout of these two levels to dictate the next direction next. All right, that means i.e. if you have an hourly close above 41,200, then potentially its impulsive up move may resume to expose the next near-term support level, next near-term resistance level at 41,535, followed by 41,800. But however, if it starts to break down below 40,610, which is so the 20-day moving average, then we may start to see the extension of this corrective decline from the high of 2nd of September, shaping further lows to retest the 50-day moving average, I think as a next support level at 40,140, and also correspond to the minor ascending channel support that I drew from the low of 5th of August. Okay, so that's for the US Wall Street 30. Nasdaq 100, yesterday we do have a bearish bias below the 19,117 short-term pivotal resistance, no change. Price action managed to stage a push-up and react off it from here. So using this 19,117 as my short-term pivotal resistance, still maintain that short-term intraday bearish bias. First support level to watch on the intraday basis, 18,680. A breakdown below it exposes 18,320 next, which cause confluence with the closely with the 200-day moving average as well. Okay, so that sum up the intraday technical outlook on the major US stock indices and as well as the other global stock indices. So with that, now let us turn our attention to the commodities market, starting with the gold XAU/USD. So for gold XAU/USD, price action managed to bounce back up from the after a test on the 20-day moving average. So no change for sure. The key short-term pivotal support still remains the same at 2,473. 200-day moving average as very closely as well, and as well as the former triangle range resistance that I drew in purple line from the high of 18th of July to 2nd of August. Broke out on the upside, now turns into a pullback support level. Okay, so as long as this 2073 short-term pivotal support holds, still maintain that short-term intraday bullish bias with a first resistance level to watch will be at the all-time high area at 2,532. Only an hourly close above 2,532 kind of increase the odds of the start of another impulsive up move to see the next resistance zone coming in at 2,588/2,595. Only an hourly close down below 2,473, that means a price breakdown below 2,403, will kickstart a minor corrective decline scenario to retest the next support zone at 2,435/2,415, which will correspond to the rising 50-day moving average as well. Okay, so that's for gold XAU/USD. So lastly, turning our focus now will be the West Texas crude oil. So the West Texas crude oil yesterday continues to plummet after hitting our resistance level, and it caged all the way down towards hitting our support level at 769.20. Okay, before coming down back down again. Okay, so with that over here, the price action on this West Texas crude oil has indeed shaped a lower low. I could see over here, but the RSI has started to shape a higher low. All right, so very interesting that there's a bullish divergence has taken shape, and also it's now coming very close to the lower limit of 68.20, which is also a Fibo extension level at 1.382, and this is a lower limit of this minor descending channel that I drew from the high of 18th of July, which is I think as a support level as well. So given the appearance of this bullish divergence on the hourly RSI, there could be signs of a slowdown in bearish momentum that has seen in the last 2 days on West Texas crude oil, and that potentially could give way for some signs of a mean reversion rebound taking shape again to retest this former major range support now turns into a pullback resistance level at 73.15/72.24. So using 68.20 as my key short-term pivotal so-called pivotal support level, 78.20 as my short-term pivotal support level, flip to a short-term intraday bullish bias on West Texas crude oil for a potential mean reversion rebound to take shape to retest the former major range support level now turns into a pullback resistance zone at 73.15/72.24 level. All right. However, if price action don't push out and starts to break down below 68.20, then this impulsive down move will resume towards 67.55/67 figure, and a break below 67 figure potentially exposes 65.10 next, which is the 2-time Fibonacci extension level over here. Okay, 65.10. Okay, and if you will look at this 65.10 over here, if you go down on a daily basis, okay, it also corresponds very closely towards the swing low area of 17th of May, so 17th of March and 5th of May 2023 over here. Okay, swing low area. Okay, so that's for the West Texas crude oil short-term intraday technical outlook, and that also sum up the intraday technical outlook on our major cross asset classes. So with that, before we go, let's have a quick look at the economic calendar. What are the key data to look out for, or in terms of data releases that will take shape in the European session and the US session thereafter. So what we could see over here is during the European session, we do have a couple of economic growth data to take note of. Will be the retail sales figure for Eurozone out at 5 p.m. Singapore time for the month of July. And we do have another second tier US job data to actually take note of, will be the ADP employment change data at 8:15 p.m. Singapore time. And the much more important one will be the services PMI, because this is a kind of a leading growth indicator for the US economy and its services, because we know that close to about 3/4 of the US economy is driven by services activity. So this is the data to take note of. So far, it has been still in expansionary mode. So if you look at the trend of the services PMI, it's still hovering at a 50 level mark over here. But if you look at the 5-year trend, it's kind of trending sideways now. So right now, there's a big risk that it could slip back into below the 50 level mark again, that what it did previously in April and in June. Okay, so if that actually takes shape over here, it could actually see potential weakness, especially on the growth, higher beta growth sensitive stock index like the Nasdaq 100 and the S&P 500. Right, so something to take note of at 10 p.m. Singapore time today. And it's also a subcomponent as well, which showing the employment, ISM services employment and ISM services new orders. And with that, other than that, 11 p.m. you have that weekly US energy agency EIA weekly crude oil stockpile change level that could actually impact the West Texas crude oil, something to take note of at 11 p.m. Singapore time. And thereafter, there'll be rather quiet on the US session, and in tomorrow morning Asia session, okay, we have nothing to actually take note of as well. All right, so with that, that sum up today's intraday, today's daily dose of market insights. I'm Kelvin here signing off, wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.